Hello and welcome to the Logistics Management Podcast. My name's Jeff Berman. I'm Group News Editor for Logistics Management Magazine and also the Peerless Media Supply Chain Group. Today, it's a real pleasure to welcome Bruce Chan to the podcast. Bruce is a managing director at the investment bank Stifel. He joined Stifel in March of 2010 and is based out of the firm's Miami office, where he covers the transportation, global logistics, and future mobility sectors. Before joining Stifel, Bruce was a senior project manager for a real estate and development firm. He graduated from Georgetown University and earned his Juris Doctor from the University of Maryland. Bruce also serves on the board of directors of Zync Inc., an automotive media and technology company. Hey, Bruce, welcome to our podcast.
Hey, Jeff. Thanks for having me. It's a pleasure to be here. I've certainly enjoyed your work for a long time, so really appreciate you having me on.
All right, likewise, and thank you. Um, Bruce, why don't we start at the top? And for those that are listening in that may not be familiar with Stifel or basically how Wall Street analysts view and approach the logistics and transportation market, why don't you tell us a little bit about your firm, your coverage, your types of research, things like that?
Yeah, so as you said, we are here at Stifel, a full service investment bank, broker dealer. We provide a number of services in and around the institutional capital and financial markets. My job specifically is to look at the transportation and logistics industry, ostensibly the public companies, the publicly traded companies, and research, understand, rate and recommend stocks to our institutional customers. So those might be hedge funds, mutual funds, that sort of thing. On the
Sure.
investment banking side, we also provide a lot of help and assistance to the companies that are looking to go public to raise capital. As research, we obviously talk to research and examine some of the macroeconomic, dynamics and indicators that pertain to the transportation industry. We also like to speak to a lot of the stakeholders, some of the smaller private companies, shippers, anybody that is in any way remotely connected to the industry to help derive our insights.
Okay, great, great. Um, and that gives you guys a lot of great insights from your sort of perch with your access to certain C-level executives and high operational ranking logistics and shipping executives too. So with that as sort of a backdrop, Bruce, and I know we could probably spend our whole podcast talking about this topic alone, but how are you sort of currently seeing the state of the freight economy? There's obviously a ton of different factors that come into play when examining it, but I'd like to hear it from sort of your perspective.
Yeah, you're right, Jeff. I've seen a lot of cycles, and I will say that this is perhaps one of the most unique, owing to some very significant, one-off events. I mean, of course, we had COVID and the ramifications after COVID. But the way that I like to couch this to investors is that, if you think about the typical freight cycle, in its entirety, it lasts maybe 12 to 18 months. And that's the reason why investors, industry stakeholders like to look at this business in terms of economic or business cycles. This downturn that we've been experiencing, as many of your listeners are well aware of, has been going on now for about 3.5 years. So
Right.
3.5 years for just the down cycle compared to 12 to 18 months for a cycle in its entirety. So it's been very significant. When we think about the causes for that, my view is that this has primarily been a supply-led cycle. First, on the upswing in supply, if you think about, back to post-COVID 2021 timeframe, we had an environment of easy lending, low interest rates. You had subsidies and transfer payments coming through from the government, and of course you had windfall earnings that were multiples of what they are in a typical freight boom, which attracted a
Yes.
lot of capacity into the industry. And I think many people have been surprised, but probably makes sense directionally that that supply has stuck around for a long time. It's been very slow to come out, and I'd be happy to go into more detail as to why. But that's the issue essentially that has been keeping the environment at bay. Demand, as your listeners know, is soft. It's been soft for a long time. But in terms of actual freight volumes moving through the system, it's not the worst, certainly, that we've ever seen, which is why we think that this has primarily been a supply-driven trough. And because of that, will likely need to be, at least in some way, shape, or form, a supply-driven recovery as well.
Okay. And let's talk, and that's a great point, Bruce. It actually was the second question on my outline. I had framed it as capacity, but supply works too, obviously. Well, why is it sticking around in that way? And a few different factors come to mind. Obviously, the things we saw in late 25 with the CDL regulations, a non-domicile CTL, and some other related adjacent things as well. Um, why don't you shed some light on that for our listeners, Bruce, in terms of how that situation or that outlook is early into 2026 and what we may be looking at on the supply slash capacity front? And I really, and for the listeners, we're really talking more about over the road slash motor carrier trucking environment here. But I'd love to hear about that from you,
Yeah,
Bruce.
no, that's right, Jeff, and thank you for the clarification. Just to zoom out a little bit, um, I think it's helpful to think about the trucking over the road market, at least from the supply perspective, kind of like the housing market, right? Where, you have a lot of people that are in at very low interest rates, and because of that, they want to lock in, that asset, right? The capital cost of maintaining the asset, whether it be a house or a truck, is relatively low, certainly lower than it would be today. When you think about the incremental owner operator, independent contractor, mom and pop truck driver, there's also not a very robust alternative employment market either, right? So,
Yeah.
financing a truck at 2%, the payment on that truck is, certainly onerous, but not as onerous as it would be today. You don't have a lot of options in terms of selling that truck in the used market for a material gain. And the alternative employment options are not spectacular. You'll probably try to stay there as long as you can. Again, similar
Hmm.
situation to the housing environment right now. So, the trucking supply environment really follows the CapEx environment and the CapEx cycle, which has decoupled from the typical business cycle. And that's what's keeping that capacity around. And that's what's been keeping spot rates at essentially break even levels on an operating cost basis. Now,
Yeah.
think about what could drive a correction or a change in that situation. It really would be an organic attrition of that supply. So the biggest factor there is operating cost, of course, and maintenance cost. If you think about the maintenance cost on a new tractor, it's probably a few cents per mile. Once you start to get towards that, mid-cycle mark, call it the 3, 4, 500,000 mile mark, that starts to creep up pretty substantially, maybe 10x is that. So you're at, in the ballpark of 30 cents per mile. That's where you start to see the pressure on the operating cost. And one of two things happens there. Either the floor on spot pricing starts to lift, albeit gradually,
Hmm.
or you start to see an increase in organic exits. Now, what really changed our view towards the trucking market and caused us to get a little bit more positive on, the rate trajectory is, as you pointed out, some of the moves by the administration, at least the regulatory arm of it, to correct the supply. And I think, the primary or the most significant piece of regulation is the non-domiciled licensing issue, which, if you look at SMCSA numbers, would be about 5% of the total Class A CDL population. But, if you think about the OTR market specifically, could be as much as 15 to 20%. Similar setup with the English language proficiency, although maybe a little bit less controversial, at least legally speaking, where we estimate maybe a 5% impact to the market. Now, certainly there's some overlap between those two populations, and the primary impediment there would be enforcement and the speed and rate of enforcement. But when you stack up these two issues and add in, some of the increased scrutiny on, call it driver schools, ELDs, I think, you have a setup where you could potentially see a pretty material tightening capacity this year.
Okay. Yeah, I mean, And that's certainly something that from the pricing rate perspective that the carriers would probably welcome with open arms, right? Not
Yeah, I think that's right. I mean, provided that they don't, fall into, some of these restricted categories with the non-dom and with the
Oh
ELP,
yeah.
the rule of thumb that we use, and it's a very rough number, but it's about a 1.5 multiplier on supply in terms of spot rate. So, the way to think about that is, for every call it 1% reduction in supply, you'd expect to see a, call it 1.5% increase in spot pricing. So,
Sure,
our
sure.
base case here, and I think, given the setup, which is relatively conservative, would be high single digit supply impact in 2026. Could be more than that. Possibly if some of the legal challenges work out, if there's some regulatory drag, it could be a little bit less than that. But our base case is about, call it 7%. So if you use that 1.5 multiplier, we'd be expecting an implied, call it, 14, 15% increase in spot pricing by the end of the year this year.
Okay. Okay, interesting. Um, the White House has certainly been front and center with a lot of things that impact freight transportation. Another thing that comes to mind, Bruce, is the this ruling with the Supreme Court IEPA tariff ruling, which honestly could be coming sooner than later, based on industry conjecture, if you will. Maybe even as soon as this week. I guess it's a two-part question, Bruce, as it relates to the transports. Um, and I'll frame it as if this, if the Supreme Court were to rule the IEPA tariffs illegal, what would that mean? If they rule them legal, or otherwise, if they rule them legal and they could stay in place, what would that mean? So basically, like an either or question of sorts, and it can be at a very top level because obviously nobody knows exactly what's going to happen yet.
Yeah, Jeff. Well, that's a big question. And I would say it gets to, the other half of the issue with the trucking, recovery or potential recovery, which is the demand side of the equation.
Hmm.
I will say, just to kind of preface this conversation, that demand is where we're maybe a little bit less bullish because I think there is a significant amount of uncertainty with the demand environment. Right now, our base case calls for, call it flat demand. Demand right now is soft, but at least it's stable. So
Yeah.
what, the IEPA ruling, which, as you pointed out, could come as soon as tomorrow, this week, could do is significantly shake up certainty and planning. Just to go through the scenarios, we think there's actually a better than even chance that the Supreme Court invalidates the IEPA justification for the tariffs. Um, but that would be most likely a narrow ruling, something along
Hmm.
saying, the Trump administration doesn't have justification to invoke an emergency ruling to bring about these tariffs. Now, in practice, does that have a huge effect on the current status quo? Maybe not, right? Because the administration can find other means of imposing these tariffs, other administrative means, or potentially even, bringing this up legislatively. Um, if things go all the way against the Trump administration, the Supreme Court says, we invalidate your complete use of IEPA. You have to refund tariff receipts. I think that would sow a pretty significant amount of chaos. Billions of dollars would have to be
Yes.
refunded to importers who initially paid these tariffs. I think that would be a negative for the economy, just given all the turmoil it would create. In a more
Hmm.
narrow ruling, if they said, look, we can't continue to impose these tariffs. You've got to find another way to justify them from this point forward. But, what happened in the past is the past. I think, short term, you could see some positive lift for the freight environment. A scenario could look like, shippers saying, wow, we have a window here where, tariffs are out or tariffs are on pause. We can stock up in advance of, some alternative means of bringing tariffs about. So you see a little bit of a freight pull forward, which of course we saw, plenty of last year.
Yeah.
And again, I think
Yep.
that would tighten up the industry. I think that would increase freight volumes at least temporarily. But it would create a lot of wake or turbulence, thereafter. So there are a lot of different scenarios that could play out here. And of course, one of the others that is not directly related to your question, but obviously this is a pretty tumultuous geopolitical environment that we have right now. We've, heard about, some back and forth on additional tariffs, to and from Europe around the Greenland issue. So,
Yes, over the weekend.
yeah, exactly. So we could be in for another year that looks similar to 2025, although I would say most shippers right now have a blueprint. So, maybe things wouldn't be as unexpected or as surprising, and there are some contingency plans in place versus, what we saw in Liberation Day last year.
Yeah, I mean that whole concept of certainty versus uncertainty continues to rear its head, so to speak. I guess under that whole tariff-driven guise, if you will, because it certainly created a fair amount of shipper turmoil is too dramatic of a word, but decision making by the day at times. Is that fair in terms of the confusion it lended?
I think that's fair. Yeah. And I guess whether or not you use the word turmoil depends on who you talk to. I think there were a lot of procurement folks that had a lot of sleepless nights. But I
Sure.
think the point is that in terms of contingency plans, in terms of partnerships, in terms of securing alternative forms of capacity, those plans are now in place and probably in some folder on a CFO's desk somewhere. So I think people feel a little bit more comfortable with having mapped out, alternative strategies in case something happens. But you're absolutely right. This would still create a significant amount of disruption in the supply chain and transportation marketplace.
Yeah, absolutely. And that just got me thinking to something else, Bruce. You had mentioned demand before, and it seems like when I read, your research reports or research reports by your Wall Street counterparts, company earnings reports, etc., an underlying theme or narrative within all of them goes back to the need for a true demand driver or a true demand catalyst to sort of help get things kind of back in sync, back on track in terms of steady, consistent volume growth. And the reason I bring that up is because I was looking at the Logistics Managers Index, which you may read as well, for December, and they were talking about the intersection of inventory and warehousing with the bleeding down of inventories near the end of the year. But made the point that it may not be just because of seasonality, or if it's because of other factors in play, like the pending Supreme Court tariff ruling. Also, the housing market plays a key role there. I mean, when we look at demand drivers or patterns or what's needed, and also as it relates to inventories, I realize this is a very jumbled question, but sort of how do you see those factors all interacting, or the confluence of them, if you will?
Yeah, it's an important question, Jeff. And the reason why I think, most analysts, most investors focus, at least historically, on demand is because most of the cycles in the past, if not, all previous cycles, have had a primary demand component to, bringing about an inflection or, often a downturn. So, typically you see demand respond first and then supply follow demand, right? It's reactionary. People come into the market when demand is tight and rates are high. People leave
Yeah,
the market when demand is loose and rates are low. Now there have been many cycles in the past where you've had both a demand and a supply component. If you think to 2019, for example, and ELD phase three. If you think about some of the EPA mandates that have overlapped, the domestic energy boom, for example, right there often has been a supply factor, but the primary driver of the cycle has been demand focused. When we look at this cycle, and this is, kind of what I talked about at the outset here, we're in a unique situation where regulatory driven supply chain is, I think, the primary catalyst for most analysts or most investors' theses on what happens with the market here. When you
right.
look specifically at demand, there are a lot of moving parts right now. As you pointed out, a lot of them being, regulatory, both on the supply side and the demand side. Um, you of course have midterm elections coming up. You've got an administration that is, doing things that are, I'd say, atypical, at least in terms of the level of involvement and the volume of issues and items on the docket. Um, we look at demand in, call it two, sometimes three different buckets, right? You have consumer, and this is very simplistic, but you have the consumer economy, you've got the industrial economy, and then I think housing is also important to focus on, specifically for freight, because it drives about a third of freight activity by volume. Uh,
Mm-hmm.
and then another kind of factor that's not as related to macro demand, but it is related to freight demand, is, as you pointed out, inventories. When we look at the consumer economy, this is really what's been keeping demand afloat domestically. There's a saying that goes, never underestimate the will of the American consumer to spend, and that, really has been true over the past few years. So,
Mm-hmm.
consumer spending and activity has been pretty decent. But I think what worries some people, what worries shippers, what worries ourselves, are some of the future indicators for consumer spending, because confidence right now has weakened substantially, and most of that is due to inflationary expectations. If you look at consumer inflation expectations, they're at close to, if not at, the highest level that they've been at since the 1979 oil crisis. So that, I think, gives folks a little bit of pause. On the industrial side, the environment has been softer. It's been, sub 50 on the ISM, which means, essentially in contraction, about as long as the freight market has been in a spot price recession.
Yeah.
And, there are some measures right now in the One Big Beautiful Bill, now, One Big Beautiful Act, that could spur a little bit of stimulus. Um, but I think it's hard to really weigh how those stimulative factors are offset by, tariffs, for example, the higher cost of inputs. So our industrials team, for example, does expect a modest recovery in the industrial environment, that we move into growth versus contraction, but it's likely going to be pretty modest. And then just to touch on housing quickly, again, there are some regulatory and administrative actions that, could stimulate the market. But, when you look at the interest rate environment, that is probably the biggest factor here affecting consumer, decisions, maybe in addition to the inflationary cost of construction. We're at very low levels of housing activity, and
Right.
unlikely to change very quickly anytime soon. So there are a lot of issues here that could play out in any one direction, but our base case is that there's a lot of pressure, and we're unlikely to see the type of material demand inflection that again, we saw back in late 2017 or before that with the domestic energy boom.
No, very good points. Um, just two more quick ones, Bruce. We can kind of do them in a bit of a rapid fire approach, just for the interest of time. One would just be late last week, the Surface Transportation Board came back to the Union Pacific Railroad and Norfolk Southern and told them that their merger application is incomplete. That by no means that the deal is off. It just means that they need more information in order to consider the deal and move on to its next steps. I know you don't directly cover the rails at Stifel, Bruce, but how would you sort of view this development, and what are your thoughts sort of on this proposed historic merger in general?
Yeah, I will say that by and large, the analyst and investor community is expecting the merger to happen. Obviously, there are scenarios that could play out, alternatively, but I think most people's view is that the merger is going to go forward. Obviously, we expect to see some concerns voiced from the shipper community, who may feel that, the rails have monopolistic pricing power already, and this merger would only exacerbate that scenario or that situation. But I think the alternative, counter argument is that there are a lot of efficiencies that could be gained from better integration of east-south rail networks, which would inure to the benefit and efficiency of the freight rail transportation system. More interoperability between geographies, between between networks, which could, very much be a positive for freight efficiency. When we think about what that means for the trucking industry, it would be that intermodal freight, for example, becomes a more viable alternative, both in terms of the service level and, maybe even in terms of price.
Sure.
So I think, that's something that, many trucking companies and many truckers may have on the top of their minds. Although, you could see the floor on pricing for intermodal lift, which, could also mean that the floor on truck pricing lifts as well.
Okay. All right. That's really interesting. And then just the last question, Bruce, would just simply be how you're sort of seeing the parcel markets. And with that, I'm thinking about UPS, FedEx, Amazon's continued inroads. The U.S. Postal Service actually has quite a strong shipping and packages group, despite its large scale financial challenges as an organization. I mean, I know that's a lot to unpack in a minute or two, but how are you seeing the parcel sector?
Yeah, it's a huge question, Jeff, and we could probably spend, a couple more podcasts on this. I would say that the parcel industry is facing a generational shift, and it's hard for me to really understate how significant the change is going on right now. Because in a post-COVID environment where e-commerce has matured, you are seeing both major domestic parcel integrators take an existential look at their networks and say, where do we go from here? And both have responded in different but ultimately similar ways in really focusing now on capital returns, return on invested capital, and what UPS has or had called bigger, not better. They don't want to build these ever larger networks to handle low yield, low margin freight, and they're leaving that type of commodity to Amazon, to the regionals, and in some cases to the USPS, and really doubling down on high yield growth verticals, healthcare, high tech, where their specific network strengths are highlighted, right? Which is a high speed global network with high yields and high returns. So
Okay.
both are reducing the size and scale while increasing the efficiency of their networks pretty substantially. So this is definitely a crossroads for the industry.
Okay. Yeah. Well said. All right. Well, look, Bruce, this brings us to the end of our allotted time for our podcast today. So, on behalf of Logistics Management Magazine and also the Peerless Media Supply Chain Group, I'd like to say thank you for spending some time with us today.
Pleasure as always, Jeff. Likewise.
Yeah, absolutely. And for those of you listening in, if you want to connect with Bruce on LinkedIn, here is the best way to do it. It's just linkedin.com/IN/J Bruce Chan. That's CHAN and another backslash. And he also is available on email at chanb@stifel.com, STIFEL.com. And for those of you on Twitter, please go ahead and give us a follow. It's really easy. It's simply at Logistics MGMT. And for those of you that are not subscribing to our podcast, please go ahead and do so wherever you get your podcasts. Just go ahead and look for the Logistics Management Podcast, and it will pop right up. Thanks, everyone, and have a great day. We'll see you next time.